RBI Governor Sanjay Malhotra, he's highlighted a list of announcements coming in. Let's start summing up all of those. First of all, repo rate kept unanimously unchanged at 5.25%. The neutral stance has been maintained as well. The big takeaway from this speech is that he sees headline inflation peaking out in Q3 of FY27. Thereafter, it is expected to moderate. He did say that supply side pressures have softened post-June of this year. So the outlook going ahead looks better. He's also mentioned that the Indian economy has performed better than expected in Q1, and on the back of all of these positive factors, the GDP projection has been hiked for Q1 and Q2 of FY27. It has been kept unchanged compared to the previous meeting for Q3 and Q4. However, GDP projection for FY27 now has been hiked to 6.7% from 6.6% in the previous meetings, with 10 bips positive outlook is what we're getting over there. On the flip side, inflation projection has been lowered for FY27, both on an overall and a core basis. Core inflation outlook is now reduced to 4.3% from 4.7% earlier. And to sum it up, he did say that global macro risks pose a risk on current account deficit, but FPIs are looking healthy. Ankur, over to you.
Yes, I would say that it is straight, sweet and simple policy. Why? Because one of the shortest speech by RBI governor, in which he did communicate, if you compare with the last policy, the situation has eased. In fact, he mentioned that supply side pressures have eased compared to June policy, and that reflected in his forecast as well. While on one hand, if you talk about the growth, which is supported by high frequency indicators such as IIP, he has upped the forecast for FY27 to 6.7%. Compared to 6.6% in the last policy. And remember, in April policy, this was 6.9%. So once again, the growth path which has been projected by Reserve Bank of India is on the upward side. While on the other hand, if you talk about the inflation, that trajectory is at least seeming well under control, if at all you see that risk which are still there, which are evenly balanced. And therefore, the inflation forecast has been reduced to 5.1%. Yes, there are risks to inflation, but he did point out few of the factors which are supposed to be noted. One, that if you exclude the fuel inflation and the food inflation, the situation is not bad. The core inflation remains well under control, and therefore the forecast for core inflation has been at 4.3%, which is well aligned with the target. Yes, it is above 4% mark, but if you exclude the precious metals, he did mention that the core inflation will also look slightly better. So there are risks which are pertaining to fuel inflation, there are risks which are pertaining to food inflation and fuel-induced sectors, which he did highlight in his monetary policy speech. But at the same time, the situation is not as bad as it would have been, and India is at a much prepared situation. He mentioned about the healthy performance which is there in the manufacturing sector. But if you look at the other side, yes, there is an acceptance that there is going to be a cost pressure in the manufacturing sector as well. Apart from that, if you look at the policy rates, yes, he had kept it unchanged. There is no change in the policy rates. But remember, ET Now's interview, in which he mentioned that stance is something which needs to be watched out for. It is kept at neutral, which indicates that RBI is clearly in wait and watch mode before taking any kind of action which needs to be taken by Reserve Bank of India.
Thanks, Ankur, for that synopsis coming in from the RBI policy. We have now joining us Radhika Rao. Radhika, what's your first take on this? While the governor is maintaining a neutral stance, he has increased the projections for GDP and reduced projection for inflation. He's also, keeping it open-ended in terms of watching out for data and the kind of impact, maybe the agri impact that may come in.
Yeah, I would say that there are three main takeaways, and some of that basis what we had just discussed going into the meeting. The first one is, of course, the pause, which was largely expected in the price, and I think that's why you haven't really seen either the bond markets or the OIS really react to this rate decision. The second was the guidance. To me personally, I did think there were quite clear signals that they're going to be much more cautious and they're going to be much more leaning towards being hawkish or normalizing policy if risks really become persistent. And I thought that the governor, time and again, when he spoke about inflation and he spoke about pipeline risks, he was quite clear that they're not going to shy away from need to tighten if risks really do rise. So I think the rate hike risk is certainly still on the table in the second half of the year. I think the third takeaway was the GDP growth numbers. We were expecting, them to that they will, at least in their language, if not numbers, highlight red growth risks. Growth was biased towards upside. In fact, I do think they have done a very small revision, or 10 basis point. When they meet next, you could see a much sharper, upside to their growth forecast. I think at this point, rainfall is the biggest risk. Our agriculture, farm sector output. Apart from that, you've really seen most of the indicators, though they're off highs, but they're not, relatively resilient considering how the global environment has been. The final point on trade, keeping up with the growth, trade, if you see Southeast Asia, for example, selected countries, exports have done extremely well. I think in India's camp, exports have done well, but not as much as what you've seen in the rest of the region. So overall, guidance as well as decision along expectations and upbeat on growth, but still worried on inflation.
Absolutely. Thanks for summing that up so well for us, Radhika. We also have Mr. Indranil Pant, the Chief Economist at Yes Bank, joining us. Mr. Pant, we'll come to you in just a minute. We also have Mr. Rama Mohan Rao Amara, the MD of SBI, joining us on the show. Mr. Amara, hi, good morning, and thanks for your time today. Like Radhika was mentioning, every time there was a mention of positivity, it did come with a caveat of global pressures that continue to be at play. How are you reading into the tonality of the governor, the tone in terms of how positive the outlook is, but it always came with a disclosure that there could be some pressures at play?
I think on a very honest assessment of what is happening, particularly the very fact that the GDP growth rate has been projected to be even 10 basis points higher than the initial estimate, also indicates that India is able to maneuver and we are able to demonstrate our resilience. But the talk of upside risks is only around to caution and kind of preparing the entire ecosystem players that more needs to be done in terms of we can't ignore those risks, and we continue to look for diversification the way it happened in terms of exports, etc. When there was headwinds were there in the trade. I think this is an indication and reiteration that risks are continuing, but at the same time, India's economy has demonstrated resilience.
Hi, Sajid here. I'm just reading out a statement from the RBI policy which says that there is a need for greater clarity to emerge, especially regarding inflation, its path and composition before taking any policy action. Any such action would also have to consider the need for recalibration of policy rates in line with the evolving growth inflation dynamics, especially the normalization of the underlying inflation from its benign levels seen hereto. Basically, the governor is looking for more data, but at the same time, to bring back inflation, there may be a calibration of rates. Is that what he's trying to say?
I think it's, while the Q1 is a pleasant surprise where while it has rised, but it was below the estimate for Q1. And it is, in governor's words also, inflation is expected to increase in Q2 and Q3 when they peak, and it is finally it is likely to subside. The very fact that some of the factors like El Nino is still, we need to see the full impact. While June was a kind of the 40% deficit was expected, but I think the July surplus could cover some of that. So that way the deficit got reduced to around 12 to 14% in terms of monsoon, while the temporal distribution, spatial distribution still is a bit of concern. And the second order effects are yet to play out. I think that was a caution, I think, shown, where there is a need for looking through the data and then calibrate the policy stance, keeping the both inflation and the growth dynamics into the picture.
the governor is, also indicated about the fact that from a systemic point of view, you have manufacturing which is doing well. There's a discretionary spend which is coming in. NIMs have been a little softer for many of the banks, but from an NBFC point of view, the system level liquidity is fine at this point in time. Do you see the kind of credit growth that we have seen getting a little more boost from here? We are at 17-18%. Is it going to remain at the same level, or are you going to see some pickup from here as well?
I think our house view is that the banking system's growth, credit growth, will be at around 16 to 17%, which itself is higher than last year. While there are a couple of areas, typically some segments around the gold loans, etc., which may witness some kind of decline, but we are seeing robust demand from other sectors, be it corporate, be it regular unsecured loans, etc. There is a robust demand. So we feel the kind of divergence what we have seen in the credit growth and the deposit growth, which almost peaked at 4%, 5% for the system, will eventually come down marginally. So that's the expectation, that while growth will continue to be robust.
Okay, understood, Mr. Amara. On that note, thank you so much for your time. We'll keep the conversation going with more experts who've just joined us on the show. We have Mr. Subodhi Prakshit, Chief Economist at Kotak Institutional Equities, joining us, and of course, Mr. Indranil Pan, who's been waiting by so patiently. Mr. Pan, let's come to you. Give us your sense on what you think the next action, the next round of policy actions could be from here. There is enough liquidity in the system now. The foreign bonds are doing really well. What do you think the next action is going to be in terms of stance, in terms of a potential rate cut? Is that something that you're seeing at play right now?
So I think you meant a potential rate hike. I don't think anybody is looking at a cut at this point in time. Now, as the governor very clearly mentioned, and this is very important, that there is a significant amount of volatility in the system. It's very difficult to actually provide a forward guidance. And for example, after the June policy, whereby he had taken consideration of $95 per barrel of oil and sort of moved all his forecasts to the higher side, we suddenly saw a slump in the oil prices post that policy. And suddenly again, as luck would have it, during the August policy, we again see a significant drop in the oil prices. But it does not take away the fact that the volatility and the uncertainty from the West Asia continues. And oil is becoming more news-based than actually purely led by demand and supply. And any further sort of re-escalation that might happen in the West Asia can also jack up the prices. So it's a very difficult scenario for the central banks across the world, and therefore a forward guidance is almost impossible. And I think he clearly therefore mentions that data dependency would be something that he would be looking at. In my opinion, having heard him, I think there are the critical things that he's looking for is, number one, if there are any second order implication of inflation. And at this point in time, inflation is not really broad-based in the fact that crude is the core inflation is lower. But if that also tends to rise relatively sharper than what the RBI expects, that would be more a broad basing of inflation. Wholesale prices are close to 10%, not much of a pass-through seen yet, but whether there could be pressures for the manufacturers to pass it through. Some newspaper reports do indicate that manufacturers are getting ready to pass that higher input cost to the manufacturing sector. Credit growth is higher, but my sense is that to a certain extent, it is also because of the higher input costs. So in my opinion, if West Asia is relatively muted, we should have a relative more consolidation in the credit cycle. Deposits will be higher, which means that the wedge between the credit and the deposit will also be coming down. So all these factors will be looked at before taking any incremental decision on the rates, and that's very clearly coming out. So in my opinion, this is neither a hawkish pause. This is more a pragmatic sort of a pause, and very clearly indicating that we are not really on top of all the uncertainties that are manifesting in the system.
Rumki Majumdar, economist at Deloitte, also joins us. But Subodhi, coming to you first, do you see there is a risk which is coming in the fourth quarter, because the governor is also mentioning about peaking of inflation at the end of Q3, and then you have the El Nino impact, the second order inflation impact, all that coming in. And so far, it's difficult to get a clarity on how the inflation trajectory will go in. And so there may be a case for recalibrating rates going into Q4.
So I think the way to look at it is that we don't know what the inflation trajectory path will be. And Indranil talked about it. I think in summary, the way we should be thinking about it is that inflation risks will continue, not just from the El Nino part, but also from global commodity prices, energy, as well as other prices. So that part continues. And I think from RBI's perspective, if you look at their first quarter FY28 forecast, that is still above 5%. So they're looking at a 5.3%. That adequately shows the kind of concern or the kind of inflation risks that continue well into FY28. And hence, I think the risks of a rate hike does not completely go away. Having said that, for now, it doesn't seem that there is any rate change on the cards. Any such action will be closer to or assessment of at least assessment of rate hike will be closer to the end of FY27 and possibly in either the December or the February policy. We'll have much more clarity in terms of how the monsoon has panned out, the progress in terms of the energy prices, and the kind of risks that we are seeing in terms of the second order inflationary pressures, and the FY28 trajectory will also be visible. So that's the time when we kind of assess what kind of rate hike cycle are we looking at, if at all.
Okay, we'll be watching out for the further policy meetings to come. Rumki, hi. Give us a sense on how you've been looking into the statements on the current account deficit front by the governor. He did say that global macro risks are likely to pose a risk on the current account deficit, and he's seeing upside risks to the CAD going ahead. Your thoughts on this?
Right. Thank you for having me over today. Yes, current account deficit remains a concern, because of the fact that exports, the pressure on exports is kind of a lot, because global demand is extremely uncertain. We are seeing shipping disruptions happening, which are kind of feeding into cost of production, cost of transport, cost of logistics. All these will have an impact on our export revenues. At the same time, import costs are going up because of the fact that, again, logistics costs are high. West Asia, west of the world is also seeing prices going up because of fuel prices, because of the disruptions to trade, which means we are also importing these higher inflation into the country. So plus we are likely to see in domestic inflation also edging up. So in a way, we are seeing a lot of factors not very supportive of exports. At the same time, imports might be growing faster than exports. So yes, current account deficit is a concern, and is something which I think RBI will closely watch out for.
But Rumki, on that note, just following up on that, while CAD continues to remain a concern, how would this pan out for the rupee? Because the governor did mention that they're not targeting any specific level for the rupee.
Sorry, can you repeat the question? I couldn't hear you well.
Sure. So since the CAD risk still looms, what does that mean? How would that translate into momentum for the rupee? Where do you see the rupee headed? Because the governor did mention that they're not targeting any specific level for the rupee right now.
True. If you look at the rupee volatility, the path has been extremely fluctuating. It is touched briefly to 96, 90, almost 97, and then again there was a period when it was down to 94. This kind of volatility is something which I don't think RBI has seen in recent past. Maybe after COVID, right after COVID, it was there. So these kind of volatility makes it very hard to predict where things will pan out, especially at a time when we know the Middle East crisis we are not out of the woods yet. We are hoping that by the end of the year, that situation will probably settle. We will also see some inflationary concerns go away. In that circumstances, I think the RBI will try to keep the rupee range bound. We do not see it moving much beyond 97, but we will probably keep seeing it moving between 95 to 97 is what we are expecting in the next few months.
Just hold on there. We also have Sadaf Saeed, CEO at Muthoot Microfinance, joining us. Mr. Saeed, can you also give us a sense of how you are seeing the liquidity on the ground, especially from an NBFC point of view?
Yeah, good morning. Thank you for having me here. I think from a liquidity point of view, you have seen the credit growth across the sectors, whether it's bank or NBFC, it's quite robust. So in terms of liquidity, it's quite comfortable, but definitely considering the growth and the demand and how governor has also given a GDP forecast upgrade. So definitely more liquidity would be needed and it will be appreciated. Governor did mention that average daily liquidity is around 1 lakh crore. So which is, I think in a normal scenario, it's sufficient, but definitely to promote more growth, a little bit more liquidity would be needed. If you ask me about the policy expectation, I think the stance and the rate is kept as unchanged as kind of what we were expected. And that was internal estimation and is also the industry was expecting. But I think what has come out as a very, very positive surprise and also to my liking it is like a dovish stance on the GDP with GDP forecast getting revised upwards and inflation getting revised downwards. So both are quite positive. And it is in line with the industry where the growth is quite robust. We are getting into a festive season where there would be a lot of demand. And also, I think with the global macros kind of easing out, hopefully, if it remains that way, I think it's kind of a very positive environment. And we can definitely surprise that GDP number.
Right, watching out for that as well. But Mr. Saeed, hi, talk to us about this one statement. How are you reading into this line by the governor, wherein he's saying that they will be harmonizing norms on loan rates for all regulated companies? Break that statement down for us. How are you reading into it?
Yeah, so Governor very clearly articulated that it is more of a transparency measure and ensuring that the customer has a good sense of what is the interest rate that is being charged. So on both the side, how the interest rate methodology works, like in NBFC, there is a clear guidance that how interest rate has to be calculated. It's a risk-based pricing methodology. Which needs to be transparently kind of displayed on the lending institution's website. So that is one aspect of it. On the customer side, I think there is a fact sheet that needs to be given to the customer, which indicates that what all components of interest rate is there and what is the effective interest rate for the customer. I think it is more from that perspective to ensure that there is transparency and there is good governance. I don't see any meddling of the pricing that RBI will do of the individual institution. It's more from a transparency and reporting point of view.
We also have Subodhdeep and Indranil and Rumki with us. Indranil, coming to you, if you look at the core inflation target, which the governor is talking about, it's 4% for excluding precious metals. It seems that the inflation or the price hikes in gold or other precious metals is now over, and the governor is discounting that in that outlook.
Well, from here, definitely the core inflation goes up, and we still don't have a very clear view of the 10% WPI and how much of that will be passed on. Now, the biggest risk from the WPI to the CPI is the fuel prices. My personal feeling is that the government will not be willing to increase pump head prices of petrol and diesel any further at this point in time, which necessarily means that the risk on the fuel side is lower. On the core, the issue is that we in the CPI, the composition of the CPI, we still have the goods related inflation the weightage is just about 28 to 30%. So I'm not sure whether, and the services sector inflation has not really moved up, except for say for example, the hotels, restaurants, etc., which the governor clearly mentioned is a fuel-led sort of change that has happened. And therefore, the thing that needs to be watched out is the extent of the pass-through. But even if the pass-through happens, the reflection of that within the goods segment of the headline inflation is likely to be not showing up in a very significant way because of the relatively sort of lower weightage of goods as a whole. So I think there is a catch over here, and my way of looking at it is that there will be more sort of looking through the very carefully through the magnifying glass whether inflation is getting more generalized and whether inflation expectations are rising. Now, for the last three policies, the surveys that we had seen, the inflation expectations of the household was on the higher side. I'm yet to see the latest survey, what comes out. And if that also shows inflation expectations on the higher side, I think irrespective of the core remaining at the 4% anchor, including or excluding the metal prices, is something that that will not be of the most critical consideration at that point in time, and RBI would be hiking rates. But at this point in time, the RBI does not see a pass-through having happened in a very significant way, and second order impact of inflation really missing.
Understood. Point taken. Just building up on that, on the services sector front, Rumki, once again coming to you, services sector continues to be one of the major growth engines for India. But given everything that's happening globally and geopolitically, how strong do you think, or how resilient do you think India's domestic demand or consumption-driven demand is to shield us from the kind of impact that we're seeing geopolitically?
Well, we have seen India's growth extremely resilient to the external sector. Like just last quarter, when we saw the GDP growth for the previous 25-26, it beat pretty much every expectations that we had, which kind of told you. And this was last year. We did see a lot of upheavals in the global uncertainties as well. So clearly, domestic demand has remained extremely strong, primarily driven by consumption. Private investment is also now picking up. So if that starts gaining momentum, we will likely have two strong pillars of the domestic demand holding up overall growth. And if you look at the credit growth, clearly we have seen the growth numbers picking up. And if you see the MSME credit growth, as well as growth to the medium sector, they have outpaced the growth of the industrial growth as well. While yes, inflation probably is one of the factors, but also the fact that the momentum has continued. The fact that somewhere manufacturing sector has held up very well. All these, and given that we are also looking at a festive season starting from September onwards, so there is a lot of pent-up demand coming up as well, because consumer demand was probably a little volatile initially, but in the second half of the fiscal year, we will likely see that also picking up quite strong. So in all, I think investments and consumptions, both of these spendings will likely hold up the growth going forward. But of course, the momentum will be a little slower than what it was last year, given that we had a very 7.7% growth last year. So from there, it will be a little lower. But the fact that RBI feels a lot more confident and has upped its growth projection tells you that maybe demand is doing much better than what one would have expected.
Okay, understood, Rumki. On that note, we'll let you go. Thank you so much for your time today, but we'll keep the conversation going with Mr. Subhadeep Rakshit. Subhadeep, talk to us about your view on GSECs, because the RBI has highlighted that GSEC yields have been supported by recent government measures and the RBI measures. Do you expect bond yields to remain anchored year on?
Yes, absolutely. The bond yield should be anchored at around the current levels, and I think there are a couple of points why we need to keep it anchored. First of all, as I was earlier referring to, the rate hike expectation does not go away. Along with that, we now have the Bloomberg Bond Index inclusion, which has been postponed, and that will kind of weigh on the bond markets, at least from a sentiment perspective. Third, the global policy rate or the global central banks, especially Fed, is probably will start the rate hike cycle in the next couple of meetings, and that will also weigh on the bond market. So broadly, if we were to think of the yields from here on, I would be looking at yields remaining anchored around with a slight upside bias in case of any kind of upside in inflation, energy prices, etc., if they were to pan out.
Mr. Said, one of the statements that came in from the Reserve Bank of India is about the agricultural sector, where the governor said that the prospects for this sector is little clouded given the impact of monsoon, the impact of El Nino coming in, and maybe inflation coming in, which may impact demand there. How are you looking at that segment?
So currently, if you look at the monsoon data, I think the number has improved. The latest number was around 12% deficit monsoon. I think there has been like a lot of covering of the monsoon that has happened over the last few quarters, last few months, and I'm sure very effectively this would be also covered in the next few days because we are seeing a lot of rains. Having said that, there would be a little bit rural inflationary pressure would be there because the inflation is getting translated from higher kind of fertilizer prices and other inputs that go into agriculture, especially the fuel prices as well. So there would be a little bit of inflationary pressure, but I think we have to watch out for the monsoon. If the monsoons are normal and reservoirs are full, I think the agriculture production would be fine. As far as what I have seen the data, the rice production, the paddy is pretty normal. Certain, I think the dal and other aspects are a little bit in the short, but definitely that will come. That will be covered up. I think the most important factor is the import aspect of the food items which are getting imported and currency also having a role to play with it. So that will impact the food items. But from the agriculture sector point of view, looking at the offtake of credit and looking at the vehicle sales that I am noticing in the rural area, definitely the demand is there and the growth is there. While there would be moderate inflation, but I don't think so it will be something to be worried about or something like what happened in 2024 when we saw double-digit inflation in food items. I don't think so we are reaching that stage as yet.
Indranil, the current account deficit has been modest for the first 2 months. We're seeing a surplus coming in there with the liquidity flows or capital flows, which measures which have come in. What is the kind of outlook that you have for current account deficit? And the second question is basically on the GDP upgrade that has come in. Do you think there is more upside to it?
Well, the GDP upgrade, the way I would put it is for the Q1, I anyways had a 7% number. So my problem is more with the second half of the year than with the first half of the year, in the sense that if inflation climbs from here on, and what we see also in the data on the CPI, the rural inflation is higher than the urban inflation. The rural segment is very critical in the sense that if food prices go up, their purchasing power for other discretionary actually goes down, which necessarily means that there is a relative downside in terms of demand that I am looking at if inflation actually climbs from here on, both from the rural and the urban sector. Now, survey-based results out of even Retail Association of India shows the purchasing of most of the white goods actually going on the lower side, including fashion items, which is something that we need to also consider as we look at demand going forward. That's on the GDP, and I think yes, there may be an upside, but it is more a technical upside rather than anything else, in my opinion. On the CAD, yes, the comfort prevails, but as we had been seeing over the last financial year as well as the current financial year, I think the critical worry remains on the capital flows side beyond the measures that the RBI has done. Now, very honestly, if you ask me, I think the measures from the RBI also reflect their worry of the capital flows. And that's exactly the reason why you build in a measure like this, whereby you want to drag in capital flows and preempt the flows that otherwise would have materialized over the whole year. You basically sort of lump it together into one sort of bucket, and that's the scenario. But given the global risks, I think the capital flows from a pure sort of play will actually be on the lower side. And that is also to do with the lower interest differentials between India and US. Shubhadeep did talk about the GSEC yields. The GSEC yields, in my opinion, the long end would be more a function of the fiscal, which we don't think any risk is there in terms of higher GSEC borrowing. Any gap can be met by either T-bills or the additional amount they garner any which ways in any year through the small savings collections. But I see an upside capped at around a 7% level. So all these factors will be sort of important for the RBI to look at, and not only the current account comfort, which can go if the West Asia crisis is once again proves to be as volatile as it has done over the last 2 months.
Mr. Pan, thank you so much for so wonderfully summing up the policy action for us. And on that note, Mr. Subhadeep Rakshit, Mr. Indranil Pan, Mr. Sadaf Said, as well as all our panelists who joined us on the show earlier, thank you so much for your insights and for your time. But with that, viewers, it's a curtains down on this very special coverage of the RBI MPC policy. Stay tuned for more action on the other side of this very short break.